Subscribe to our YouTube channel for in-depth interviews of India Inc. and press the bell icon so that you do not miss our updates.
Hello and welcome to Nirmal, ladies and gentlemen. I'm Hiral Dadia. We have with us Mr. Hans Goetti, founder and CEO at HG Research, joining in. Welcome to the show, Hans, and it's a pleasure to speak to you after a really long time as well. My first question coming to you is the key point of conversation that everyone is having right now is we thought probably by the end of the calendar year 2020 we could see some bit of cooling off happening on the impact of COVID-19, but that does not seem to be the case at all with the second waves that have been probably hitting western countries right now. uh, Taking the rise in terms of the COVID cases globally right now, the first thing is, what is the kind of economic impact are we expected to see further? Because again, everyone was anticipating that by the fourth quarter of FY21, probably we could see some bit of pickup that could start happening.
Well, it will depend on the response by the authorities. I mean, we have these divergences. For instance, China, they had this virus first. They had a very severe lockdown and got it under control. I'm sitting here in Singapore. We had the same thing. We had a lockdown lasting about 3 months. It was extremely rigorous. We have no cases at the moment. Of course, the borders are closed. Nobody is traveling. But with lockdowns, you can actually get it under control. The problem in Western societies is that you cannot implement the same measures in a what they would call democratic society, where people think they have individual rights. So that's why these lockdowns in Europe and the United States have not worked so far. And now what we have are economic. We can also say the economies have been detonated, and yet the virus is not gone. So that's the worst of all worlds. So what's going to happen now going into the fourth quarter is winter is coming. People will spend more time indoors. And it seems to me that in Europe, at least, and the United States, they will probably have to tighten the lockdowns again. And yet nobody wants to have a total lockdown as they had in March and April, because the damage to the economy is too big. So I think at the end of the day, I mean, it's sad to say, but probably some kind of herd immunity will have to happen, and this could take months. So I think winter doesn't really look very good, and the economies will suffer. And I think that's why everybody is so adamant about the fiscal stimulus everywhere. That the government can jump in, but even that, I mean, look at the United States. That's unlikely to happen this year.
Absolutely. And Hans, what's happening is with the healthcare impact that we've seen, with the impact that we've seen on the economy, we have no correlation that's actually existing between markets and the performance of the economy. There's a complete disconnect that we've been seeing at this current juncture. What is it that you see right now in terms of valuations? Because there has been a major rally, if you see from March lows to now.
Yeah, I mean, I'm looking at the US market usually because that's a proxy for the whole world, more or less, at least for the developed markets. And what we see there clearly is that, as you rightly say, there is almost zero correlation between the real economy and asset prices. Asset prices are driven literally by monetary policy. The Fed has been extremely aggressive. I mean, the Fed has basically doubled its balance sheet in the last 6 months, from 3 trillion to over 7 trillion and counting. So deficits are going through the roof. Um, in March, you saw earnings coming down, or in April, and yet the market went up. And now it seems to me that earnings estimates or earnings are coming in better than expected, and the market seems to stall. So it's pretty much the opposite. So I think we have reached a level now in terms of valuations where you could actually see some pullback, but of course the pullbacks will probably be limited because the Fed will be there. The Fed has the markets back, and I think for now, yes, I think there will be pullbacks, but whenever it gets too bad, the Fed will intervene one way or another.
So, Hans, are you saying that you're still optimistic and bullish about US markets and you're not really seeing any correction that could be on the cards in the next 3 to 6 months?
I think there could be a correction. I think everybody's now salivating over stimulus, as fiscal stimulus, but that seems not to be forthcoming. So I think over the next few weeks, we're going to see tremendous volatility. Also, it will depend on the outcome of the election, whether we're going to see a blue wave where the Democrats sweep the White House, the House of Representatives, and the Senate, or whether the Republicans will be able to retain the Senate. And of course, if that happens, any stimulus package will be a lot smaller. So a lot of these things will depend on it. But at the moment, markets are literally driven by sentiment, expectations for stimulus, and market positioning. The fundamentals are actually deteriorating in a world where you don't have additional fiscal stimulus.
Right. And with this, what's happening is, again, key eyes are on whether the stimulus package comes in ahead of the US elections, or is it going to be after the US elections, and if there is going to be any. What are your odds stating right now between Biden as well as between Trump?
Well, I think the odds of a stimulus package before the election is shrinking by the hour. I mean, it does not seem to happen. I mean, I would be really surprised if they came up with something in the next few days. The House of Representatives has gone home already. Senate is still there, but they're leaving today. They could recall them for a vote theoretically, but time is running out. Will there be a stimulus package in the lame duck period after the election? I don't think so. So stimulus probably will have to wait until 2021. As far as the outcome of the election is concerned, very difficult to say. It looks like the Democrats are leading, but as we've seen in 2016, that there's room for surprises. So for me, I think the election is going to be a lot tighter than most people think.
Right. And with this, another aspect that we're witnessing right now is with regards to what's happening to the US yield curves as well. What's the sense that you pick up? Because there was an anticipation that, clearly, last couple of days, if you go to see, it's in the steepest in nearly 3 years. And again, this wasn't the potential for an election blue wave. Again, we've seen some bit of flattening that's coming on the yield curve. Where do you see it moving from here on? And in turn, what's the kind of impact that you see on the dollar index as well as the currency?
It's always interesting and almost amusing to see how the bond bears come out of the woodwork when the yield goes up by 20 basis points. And of course, yields are low, obviously. We're now at 80 basis points. I believe that long-term yields are a reflection of long-term inflation expectations. And the way I look at it is that inflation is not a problem as long as you have an output gap in the economy of 8%, of minus 8%. The economy, there's so much slack in the economy right now that inflation is it's very subdued, clearly. And also the way you measure inflation in the United States, CPI inflation, 30% of the CPI is shelter, in other words, rents, and rents have come down quite dramatically. So I think those people who are looking for inflation, they may be wrong-footed. And also what you're seeing here is that a lot of people have bearish bets on long-term treasury bonds, and I think they could be caught flat-footed as well. So to answer your question, I think this steepening of the yield curve is temporary. And I think we're approaching very fast, buying opportunity for longer-dated bonds in the US, treasury bonds.
Right. And how do you see the dollar index moving from here on? Because again, it's trying to reclaim that 93 level. Do you think that's something which is going to be sustainable?
Well, the dollar obviously has been oversold. It's bouncing around now. But if you think about the stimulus that, let's say if you have a blue wave, Democrats take over, you could have a stimulus of 3 trillion or something, and the dollar would clearly react negatively to that. I think I'm watching the 91 level on the DXY. If that's broken on the downside, I think then we can see much lower levels in the dollar. And of course, conversely, higher levels in the metals like gold, silver, and so on. But at the moment, the dollar seems to be bouncing around from an oversold position. So it's a bit of a trading range right now.
Right. Apart from these two events with regards to US, another important event, Hans, that we have been looking at for quite some time is with what's happening on the Brexit front. What's the sense that you pick up? Because you're seeing a lot of impact on the back of the negotiations that have been happening on the euro as well as the pound, because the volatility has continued to remain really high.
Yeah, it's hard to say what's going on in the minds of politicians, but I think there is a willingness on both sides to compromise for a deal. And if you look at the British pound, I use a lot of technical analysis, and for me, the British pound actually looks quite attractive compared to some other, not only to the dollar, but also some crosses. So that to me is an indication that the market expects some kind of an agreement last minute. Maybe this is all negotiation tactics and everything, but I'm cautiously optimistic on the Brexit file.
Right. And overall, with regards to where markets are concerned, if you have to look at emerging markets right now, where would you place your bets? Because India, again, on the valuation front, if you go to see, is still expensive. What's your perspective?
Well, when it comes to emerging markets, I think one of the markets that stand out is China. I mean, China went into this COVID-19 as just the first country, comes out as the first. And it seems to me that the Chinese economy will be the only economy that is growing this year, at least one of some of the, as opposed to all the other bigger economies were actually contracting. And China has, I think, in that sense, an advantage. They have a big domestic market, and I think they will focus a lot more on domestic consumption because the recovery that we're seeing in China now is mainly domestic driven. And I think the goal here is to get a domestic driven economy and also become a lot more independent in terms of the technology sector. I think they know that they cannot rely on supplies from the US. So I think these are investment teams, the Chinese consumer, Chinese technology. And I think that for me stands out among the emerging markets.
Right. Apart from equity right now, Hans, what other asset classes are you recommending? Because what's happening is, especially with regards to where gold goes, it was considered as a safe haven. We did see some bit of profit booking that started to come in, especially with regards to gold as well as silver. And now, again, on the back of, the US stimulus, probably elections as well, you are seeing some bit of interest that's coming back in terms of gold as a safe haven. What's the sense that you pick up?
Okay, I look at gold and silver as insurance policy against currency debasement. It's questionable whether it's a portfolio instrument at all. I compare it to fire insurance. When you buy a house, you buy fire insurance. Of course, not in the hope that your house will burn down and you get paid, but just in case it happens, that you have a backup. You get paid, and it's similar to gold and silver. I mean, if you have currency debasement the way we have, with central bank balance sheets going through the roof, I think that's where you want to get back in. But if you look at it as a portfolio investment, I think from a technical perspective, there's a very crucial point right now. I don't know whether it's going up or down. I think in gold we could go as low as 1760. That's where the 200-day moving average is. But for me, that would be some kind of a worst case scenario. I think the gold price will probably hold at 1850 or something like that. Eventually, it will go a lot higher. Silver will eventually go a lot higher too. But we're going to have some interim volatility, which also will depend a bit on the outcome of the elections in the United States.
Right. And apart from this, Hans, what do you think of crude? Because clearly there was a point in time where crude actually enjoyed its premium status of a sound financial asset for years, where probably there were people who even compared its intrinsic value to gold. However, things have completely changed when you talk about 2020 and crude. And the performance that we've seen so far this year actually describes this as anything but stable. What do you think of what should be happening with crude from here on?
Well, crude has been in a sideways trend now for a number of months, a very tight rating range actually. And I think OPEC wanted to increase production in January, I think 1.9 million barrels or something like this. But with COVID-19 back in the US and in Europe, the demand from that side will be lower. The only demand you see for oil right now comes from China, really, the growth at least. So my guess is that they will probably hold back on the production increase. So there will be a lot less, if any at all. And they will want to make sure that everybody adheres to the rules. I would watch this trading range where we are now. I find it very hard to believe that crude will go a lot higher from here because of the weak economic performance in Western countries, especially because of COVID-19.
Right. And then especially with regards to crude, as we saw on the 20th of April itself, Hans, WTI futures did tumble to negative $37.63. From there, if you see the kind of recovery that we've seen right now, it's recovered some of its losses. We are in that range of, say, $40 to $42 per barrel in the spot market right now. Does that mean that we've restored its value and probably could be a good addition to one's investment portfolio from here on?
Yeah, I would think so. I mean, okay, the minus $45 was a technical aberration. I don't think we're going to see that. I would be really surprised. But I think, yeah, I think what you want to look at if you really want to invest in the energy, I think I would look at some of the stocks that have very high dividends. And of course, at the moment, everything looks bleak. This sector is completely out of favor. And if you have a long-term view, I think some of the big oil companies could actually be quite attractive here.
Right. So, Hans, if someone has to look at making investments and the equity side of business right now, which are the areas, which are the sectors that you would be recommending? Because what's happening is, even for a country like India, now they are probably getting an opportunity to be known as a manufacturing hub because a lot of global companies are shifting their base from China. Yes, India could be one of the options, but yet they have to compete with countries like Bangladesh, Vietnam, Taiwan as well. So, what sectors of business would you recommend in this current situation?
Okay, specifically India, I think manufacturing will have a revival. I mean, the government is pushing it; they want to promote it, and so on. And I believe that's a great area. I think also information technology exports will do well out of India because what you have, a big investment theme globally is the stay-at-home investment theme. I mean, you've seen this massive shift from going to the office. Everybody goes to the office, and half the people are working from home. And this, I think, is here to stay. I'm not sure that 50% of the people will work from home, but I'm sure that we will not go back to pre-COVID conditions where everybody goes to the office. So I think if you play that theme, for instance, online shopping, obviously people who work from home do that. Then you have semiconductors. You know, I mean, the semiconductors would benefit from that. Cybersecurity is another theme. So anything that has to do with the stay at home and people working from home theme, I think is a secular trend. It's in a secular bull market. That's how I will position myself in equities. And as I said, in emerging markets, I would take a hard look at China, clearly. Other than that, I would like to balance out the portfolio with some US Treasury bonds. I mean, not because of the yield, but because of some possible capital gains, and as a balance to a portfolio.
Absolutely. I think these are areas that everyone's watching out for as well. Thank you, Hans, so much for joining us on the show. It was a pleasure to speak to you. Great insights that we've picked up. I hope you enjoyed the conversation as well. And take care, be safe, and we should come back to you soon again.
Thank you very much.
Thank you.
You too. Bye. Bye.